If you've been Googling top rental property financing options and you're a veteran or a first responder, you're in the right place. If you pick the wrong loan, you're going to overpay, get stuck, or miss deals that you should have won. Do me a favor before we get started. Hit like, subscribe, and ring that bell. This channel is built for veterans and first responders who want real estate results without the hype. I'm Bud Evans. I'm a retired Air Force officer, retired police officer, former mayor, and I'm a New Jersey agent investor with 50 plus rental doors. I teach veterans and responders how to buy, finance, and operate rentals with discipline and actual numbers that work. So here's the rule. You don't pick a loan first. You pick your plan first, then you match the loan to the plan. Also, if you're a first responder and not a veteran, you're not eligible for the VA loan, but you need a different path, and you still have great options. So let's talk about the first loan, the first option, the VA loan for a house hack. Veterans only. If you're eligible, this is your best bet. It's a low cash entry point. You can buy a 1 to 4 unit property with zero down as long as you live in one unit as your primary residence. You rent the other units out and then let the rent help pay your mortgage. Now, this is why it works. You keep your cash for reserves and repairs. You avoid monthly mortgage insurance. You usually get strong pricing versus other loan types, and you get an exit strategy. Once you satisfy your occupancy requirement, you move out. You rent your unit, and then the whole property becomes a cash flow rental. Second, FHA loan and other low-down owner-occupied loans. Veterans and first responders. If your VA is not available or you're a first responder, FHA is the most common starting point. You can put as little as 3.5% down, and you can buy up to a 4-unit property if you live in one of the units. But here's what you're trading. You're going to pay mortgage insurance. You're going to have tighter property condition rules than conventional loans. If the property needs work, you're going to need an FHA 203K rehab loan that will be bundled with your purchase and rehab. But you need to be realistic here. It's paperwork heavy, it's slower, and it needs contractors who can deal with draws and inspections. If you're new, you're usually better off buying something livable that's just a little dated. Here's another option. This is something that's grossly overlooked. USDA loans. These are great for the right locations. USDA is a zero-down primary residence loan in eligible areas. And yes, some of those areas are suburban, not just farmland. This is not a direct rental loan. It's a primary home play that can turn it into a rental later. So here's how you use it. You buy your primary residence with zero down in a USDA eligible area. You live in it, you build equity, you stabilize it, then you move up later and you keep the first home as a rental, assuming you meet the program and lender requirements. USDA is usually best for single-family homes, not 2 to 4 house hacks, so don't confuse it with VA or FHA. It's a stepping stone option that can be powerful for first-time home buyers or first responders in outer suburbs and smaller markets. Fourth option is the one that everybody thinks about first, conventional loans. Don't use it first, though. It's a long-term workhorse, and that's great, but once you're past the first deal or two, most investors live here. Conventional loans are what you use for long-term rentals when you're not living in the property. But there are typical expectations of 15 to 25% down on single-family rentals and often 25% down for small multifamily properties. Lenders care about your credit score, your debt-to-income ratio, and how much you have in reserves, and they're going to want you to prove that too. So they're going to want pay stubs and taxes, etc. If you have a steady income and good documentation and decent credit, conventional is predictable and scalable until your debt-to-income starts getting a little tight. And remember, it's limited at 10 properties. Here's your fifth option, DSCR loans. And this is what I do with my BRRRR properties. I let the property qualify. DSCR stands for Debt Service Coverage Ratio. It's simple. The lender cares about whether your rent covers your payment with a cushion, right? This is a strong option when your personal debt to income is tight because you already own a few properties, or you're self-employed, or you want the deal underwritten mainly on the rental income and not your personal income. The rate's going to be a little bit higher than a conventional mortgage. You're paying for flexibility. You're going to use DSCR when it helps you buy the next property without your personal ratios killing the deal. Here's a sixth option, and this is grossly overlooked. Creative and short-term financing. Use this with discipline, though, because this is where investors start moving faster, but it's also where people get hurt if they don't have a solid plan. The main tools here are a HELOC, where you're borrowing against your equity from your personal property or an investment property, your rehab, your closing costs. Another is private money, where you borrow from individuals with negotiated terms. Last is hard money, where you're borrowing short-term at a higher cost, but you're going to get a faster closing, and it's perfect when the deal needs a heavy rehab. These are best for what I do, which is the BRRRR strategy and rehab deals where conventional and FHA won't touch the property, but you need an exit plan before you close. If you don't know exactly how you're going to refinance or sell it outright, you're gambling. So look, if you're a veteran, and you want to be around other veterans executing at a higher level, check out the War Room led by David BRRRR. It's veteran only, and it's a legit room for disciplined operators. If you want a one-off coaching call with me, you can go grab that at buddevans.com. And hey, if this is helping you, don't forget, hit that like, subscribe button, and notification bell, and share this with your friends. Now, let's match the loan to your strategy. Ask yourself this: are you willing to live in the property for at least a year? Is this a straight rental, a house hack, or a rehab? Do you need the lowest payment, the lowest cash out of pocket, or the fastest close? So let's match these up for you and give you a little bit more logic. If you live in it and you're VA eligible, VA is obviously your first look. If you live in it and you're not VA eligible, FHA. If you want zero down and the area qualifies, USDA can be your entry move for a single family home. If you're buying a straight rental with solid financials, conventional is the clean path. And if your DTI is tight or you have more than 10 properties and you want to get into the next one, you want scaling flexibility, DSCR is a strong tool. If the deal needs heavy rehab or speed, look at using a HELOC on one of your rentals or on your personal home. Use private money or hard money, but only if you have a clear exit strategy. Here's a recap checklist you can use before you talk to any lender. Number 1, define your plan. Are you house hacking? Is it a straight rental, or do you need rehab? Next, decide your occupancy. Are you going to live there or not? 3, identify your eligibility. VA, veteran only, FHA, most buyers, USDA only if the area and income rules fit. Number 4, know your baseline numbers, your credit score range, your monthly debts, your income, your cash reserves. Number 5 is estimate your real rent and real expenses, taxes, insurance, utilities, repairs. Don't forget to include vacancy, maintenance, and capital expense. Number 6, pick your top 2 loan options that are going to match your plan. Number 7, talk to 2 or 3 lenders and ask which option they recommend for your exact deal and why. Number 8, stress test the deal. Assume higher repair levels, lower rent, and see if it still works. Always check for management too. 9, confirm your exit plan if you're using short-term money, refi, sell, or your cash out strategy. Hey, if you got value from this, do me a favor, hit like, subscribe to the channel, and ring that notification bell so you don't miss the next checklist. And if you're a veteran and you want War Room details, comment War Room down in the comments and I'll point you in the right direction. Thanks for watching. I'm Bud Evans. Aim high, execute fast. See you on the next one.